Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Hope you are able to hear me. Let me display the PowerPoint presentation. Tracking the forex market together. So, myself and you people are going to track the market together using our concepts. So, it is going to be the second part of this particular twin webinar, which I give once a month. And today, August 27, between 14 and 14:45 GMT, I'll be tracking the market along with you. So, in the part 1, which I gave between 5 and 5:45 GMT, I had taken certain trading decisions and also gave the forecast, and subsequently what happened to the forecast and what happened to that of the highs and the lows. So the forecast we wanted to check, then subsequently the market reading with regard to the highs and the lows we want to check, and also finally analyze what happened to our trades. So let me give the link for the live market code page. Focus the camera over the live market code page. Currently, Euro is trading around 1.2707, 1.2709, and it was hovering around 1.2730 and subsequently made a dip. The low is 1.2693 and which is intact, which was formed during the early Japanese session and not been breached, and the high has been breached nominally. So I will show the initial lows and the highs which are being noted down for you to make a comparison what has happened throughout the day. Then in the case of GBP, it has currently cut the recent low 1.5470 and come down little bit to 1.5064, and you know that the Fed chairman speech is there, so the players want to make some reactions to that, and the high is 1.5541, which has shown during that of before the release of UK GDP, and subsequently they made the swings, but not much of moves are seen today. And GBP was in the negative territory during that of the European session. Now it has come down, made a little bit of downward stop, and currently it is showing 68 pips negative net change, and Euro is showing about 30 pips negative net change. They breached the low in the case of GBP Euro also, and 1.2693 was the initial low, and subsequently they breached and come down to 1.2681. So we will review how exactly the market is expected to make based on the market reading and also based on the forecast, and then subsequently take the trading decisions. Before going to that of the trading decisions, now they recently cut the high in the case of Euro and GBP, so we need to wait because it is exactly by 14 GMT they cut the low, and we have to wait for about 30 minutes to confirm whether it is a stop and or a knee-jerk reaction just for the Fed chairman to initiate the talk, and then subsequently what exactly they want to do it, because he would not have even addressed the gathering before that they made the dip. So obviously you can understand that the players make use of the market speech, data release, etc. as the trigger time, and they try to do the triggers depending upon the traders' pending positions. So obviously it shows that some of the traders or predominant of the traders are holding long positions in Euro and GBP, so they are just making a brief downward stop and quickly gain the levels in the case of Euro. So it was a quick stop and so 1.2693 was the low, and they breached and came down to 1.2681 and subsequently gone above that of 1.2693 in just a fraction of a second. So we understand that it is a stop and so once we know that it is a stop and briefly done during the start of the speech, so obviously they wanted to make a gaining move after that. So that is what we try to read it. In the case of GBP, they are still holding below that of the initial low. The initial low was around 1.5509, and then subsequently they breached and came down to 1.5470, and that also they have breached it and come down to 1.5457 and currently trading around 1.5464. Still we need to wait for about 30 minutes to find out whether they wanted to really rise or they wanted to lag the rise in the case of GBP in order to gain the levels in the case of Euro GBP or something like that. So they could handle the crosses and later on come to the other majors. So we need to find out what they intend to do, then take the trading decision. In the case of CHF, they breached the low which was set initially 1.0226 and then came down to 1.0222 and then subsequently it has gone up and they cut the high also. They are holding above that as a high. So, and in the case of Canadian dollar also, they cut the high now, 64 pips positive net change is seen. And in the case of Australian dollar, they breached the high set initially and then subsequently came down and they are hovering around that of the middle level till the low has not been breached. So let me show you the initial lows and the highs set for today so that we'll be able to understand how exactly they have made the moves. Now this is the slide to show the initial lows and the highs set for today between 2:30 and 3:30 GMT during the Japanese session. So in the case of Euro, 1.2693 was the initial low, it breached and came up, and again they had dropped it and come below that of 1.2693. So let us wait for 30 minutes and then try to take a decision on taking the position. If they sustain below that of 1.2693 for more than 30 minutes, then obviously we understand that they wanted to drop further down, then probably you can do a technical trade of sell and buy. And otherwise, if they just cut the low briefly by about a few pips and come up and then stay above this 1.2693 for 30 minutes, then we will try to take a buy and sell trade. So that is how the trade decisions are going to be. And in the case of GBP, 1.5517 was the initial low. They have breached it and they have come down to that of 1.5445. Quickly they made the drop of net changes, now 74 pips. The high also they breached during the GDP release of UK, and then 1.5532 was the initial high, and then they breached and went up to 1.5541, and then they had done the downward stop. So obviously it shows that the traders are holding the mixed positions, the higher level longs and the lower level shorts. So obviously yesterday they made the rising move in order to hit the stops of the short sellers, and when the traders have turned long and they are trying to do the downward stop now, and later on what they intend to do is more important for us, because stop and is part of the game either on the upside or on the downside. But ultimately, whether they are going to gain the levels or drop the levels is going to be important for us. Now, in the case of CHF, the low was breached. 1.0226 was the initial low, and then they breached it by 4 pips, and then subsequently they cut the high also. 1.0247 was the initial high, and they have gone above. Now it is 1.0283. And if they sustain above this 1.0247 for more than 30 minutes, you can do a buy and sell trade as a technical trade in the case of CHF. Then USD Yen 84.29 is the low, and they dropped a little bit. They went up to the 85 area. 84.56 was the initial high, and then they formed a new high 85.10, and then subsequently they have come below 84.56. So you can understand a quick upward stop and they have made it, and then subsequently they have dropped it in one go, and now they are just holding around this. How far they are going to move it, we have to see. Probably in order to handle the crosses, they will make either way moves in the case of yen, so that the yen crosses will also make up and down moves. And in the case of Australian dollar, 88.46 is the low, still they have not breached it, and 88.66 was the initial high. They went up to 89.11, and then still they are holding above that of 88.66. And as I explained many times, the commodity pairs are used as a lead by the players. So here you come across that still in the case of commodity pair, they are holding it above that of the initial high. So the actual intention is making a downward stop and then subsequently make the rise. So again euro has come above quickly, and GBP they wanted to gain later on because initially they wanted to gain the level and make some upward stop in the case of euro GBP and also other euro crosses, and then subsequently GBP will also follow the gain. And in the case of Canadian dollar, 1.0570 was the initial low, which is intact, and they have not breached it. And I was expecting a brief downward stop, and they have not done it. And they came up to this level, and subsequently they had gone to that level of 1.0585 and above the high, initial high. Currently, it is trading around 1.0639, and the high is 1.0646. So you find the net changes gained about 60 pips. So now you find that CHF has gained nominally, whereas Canadian dollar has gained more. This I explained it many times that they wanted to rise CHF CAD across. For that purpose, they are making this week. So probably last month you might be knowing that CHF was looking weak and it was trading around the 1.05, 1.04 area, whereas they dropped CAD, Canadian dollar, or USD CAD to that level of 1.01 area and then subsequently gained. Now Canadian dollar is ahead of this time. So this is how alternatively they make the moves in that of the four majors and two commodity pairs. As a result, you find very good volatile moves in the case of the crosses as well. So let me minimize the PowerPoint presentation and focus the camera over that of the current presentation, tracking the forex market together. So with regard to the initial, what had happened to that of the market, I explained it. Then also initial highs and the lows, I compared it with that of the earlier Japanese session, initial highs and the lows, and current market we have compared it, and we have seen that they are still holding around that of 1.269093 now. So 14 GMT they started making the dip. Before 14:30 GMT, if they sustain above that of 1.2693, then we can see the final rise. Now let me refer to that of the earlier trades, what I explained. So 1.2693 was the low, so I kept a buy limit order 1.2695 during that of the part 1 of tracking the forex market together webinar, and that limit order got filled when they came down to that level of 1.2694, and that became the position. I kept an entry stop that was not filled. Then it went up to 1.2732. Then I used the trailing stop of about 5 pips because market was looking very, very weak. So I tightened that trailing stop and it got filled, and I was able to gain about 27 pips in that buy position. And similarly in the case of GBP, below, just about 2 pips above that of the initial low, 1.5517, I kept a buy order. During the webinar itself, it got filled and it came down to that level of 1.5497 at that time. The initial the hedging order was not filled, and subsequently they dipped before that of the during the start of the European session. So that got filled and I was watching, and they formed the low as 1.5488, and then I was able to keep a stop at entry, and then once it was closed, I kept 30 pips below another hedging order, that is 1.5461, and then that was not filled. Then subsequently I trailed the hedging order upward, and before the GDP data release, they went up to 1.553437, and quickly I closed it with a nominal 11 pips profit. Normally I used to book very good profit, but today the market looks very, very subdued and not much of volatile move. So obviously I will not gain, but still I was able to capture the profit and not holding a loss-making position. Then in the case of USD CHF, I kept the buy limit order 1.0228, and the low was 1.0226, and they breached and they filled it, and my hedging order was not filled, and it went up before the close of the European session. Then I subsequently booked the profit at 1.0248, and I was able to capture about 20 pips. Then Australian dollar, I kept a buy limit order above that of the initial low and that was not filled, which indicated that they wanted to really gain the levels in the market, and they might make subdued stop-ins, but they are all only to distract the traders and create the fear. But actually, the players are buyers, and they want to accumulate the buy positions here, and then subsequently make quick rise from next week onwards. The next week you come across the week in which you find the month of August gets over, and then subsequently the month of September is also the early September falls in that, and also you come across the important events like the ECB interest rate decision, ECB press conference, and also non-farm payrolls, and they are expected to make very good gains in the market using such data release times. Then, in the case of the N crosses near that of the low, I kept the buy limit orders, but it was not. Now only you come across that in the case of Euro GBP, they came up to that level of 0.8223, that is the calculated level. I kept that was not filled till that time, so I removed the order. But now you find that they come up to that of 0.8223 because the initial high was 0.8198. So I expected about 25 pips upward move as an upward stop and then subsequently making the slide, and I recommend 50 pips hedging order, and during the upward stop one could take a sell position, then you will be able to easily keep stop again. But I would retain that order, then probably it would have got exactly filled, and then subsequently they come to that level of 0.821114 level. Then if they make a little more dip, we can keep stop at entry. That is how one can take the trading decisions. So ultimately, when you are using the hedging order, any level, whether you are buying euro at 1.21 or 1.22 or 1.26 or 1.29, you are only taking a risk of 30 pips. Keep that in mind. When you compare it to that of the earlier levels, then even this 30-40 pips swing trade, you will not be able to, you will start developing the hesitation. So obviously, when you want to live in the present condition, then look at the present price action rather than trying to compare it with that of the earlier levels, which might be good for a long-term understanding of the market and identifying the trends, etc. But we are prepared to do either buy and sell trade or a sell and buy trade, irrespective of the market conditions, provided we foresee a quick gain is expected based on our market reading, then we do a buy and sell trade. If there is a quick drop expected, then we do a sell and buy trade. So ultimately, we try to take a limited risk of 30 pips. Once the position makes profit, we keep stop at entry and reduce the risk to nil. So that is what happened with regard to the initial trade. So let me go to that of the market timing. So these are all the timings followed by that of the big players. Japanese session 0030 to 7 GMT, 7 to 7:30 GMT is the gap time before the bank deal rooms officially open for the currency conversions, and that time is being made use of by that of the players to do the upward or the downward stop ends. So you come across the false moves during those gap times. Then afterwards 13 to 13:30 GMT is the gap time before the start of the US session. Now US session starts by 13 GMT, 14 GMT. We are reviewing the market. You find that exactly by 14 GMT because of the Fed chairman's speech. So they made a quick downward stop and then they are making the recovery now. So once you find 14:30, they will be above that of the initial low. Then we can happily take a buy position and you will be able to see profit without giving much importance to what the chairman said or what happened to that of the GDP data, etc. They are all used as attribute. You know that a positive GDP data was released from that of UK, but still they made the drop in the case of GDP. So you can understand that they can give any way the interpretation. So if it is a positive data, they can say it is already discounted in the price and they need not make a rise. If there are traders are holding higher level long position, not liquidated before they wanted to make a rise, then they can do such interpretation. So interpretations can vary from time to time. Even though the data might be the same, you know that with regard to the interest rate, they are not gained or they are not raised the interest rate for nearly about 8-9 months. But still, every time anxiously people look for it, and anxiously people say that there could be some important information with regard to the messages what they are going to release, and subsequently you find the market behaves in a different way. So instead of waiting for such data release and trying to read in depth with regard to the interpretation, we can focus on the timings used by the big players to make the up or the downward move in the case of the market. And we have to read what they intend to do. Always they make a false move before their intentional move. I explained it in my trading system webinars. So if you go through that, you will be able to understand what are the type of moves they make it before the data release and after the data release. And so when they make a false move before the data release, then you can understand they wanted to gain the levels after the data. And for example, US GDP, UK GDP data, before the data, they gained the levels in the case of GDP. Even though the data was good, they dropped afterwards. So a false move is made before that of the intentional move. If you understand these moves very clearly, then there won't be any fear in taking positions in the market. So how exactly our basic trading strategy works? So we watch the forex market in all the 6 pairs, 4 majors and 2 commodity pairs, 30 minutes from the start of the session. So 13:30 GMT, the US session starts. So till 14 GMT we watch. Then we take a sell position if a pair is near the high and not cut the high. And similarly, if the pair is near the low and not cut the low, we try to take a buy position. But today, we have seen they cut the high, they cut the low in the case of Euro and GBP. So we wanted to understand whether this drop is really a stop and or an extended move. How we differentiate whether the drop is below that of the initial low is stop and or an extended move. So they dropped it, and in less than 30 minutes, if they come above that of the initial low, 1.2693 in the case of Euro, for example, then sustain there for 30 minutes, then you understand that they wanted to gain the levels and the earlier move was a stop point. And once you follow these moves very clearly, you may not even wait for 30 minutes. If they come above that as a high and sustain for 10 minutes, then you can try to take the buy position and they will be able to do it. And also, if you become very smart during the stop and when they dropped and that particular low they are not breached, for example 1.2677, 1.2681 they showed it as a 83 they showed it as a low from 1.2693, 10 pips drop, then subsequently 1.2681 and 1.2677. Okay, 3 drops and they stop cutting the low. So by 14:30, if they stop cutting the low, straight away we can take a buy position also near the low. So this is how we determine using our concept. In case if they don't come above that of the initial high in 30 minutes time frame, then around 1.2690 we will try to take a sell position. If till 14:30, if they are not going above that of 1.2693 and sustain there for about 10 to 30 minutes, then we will try to take a sell position and it could give about 20-30% profit downward. It will be a technical trade. So using the initial highs and the lows, we try to track the market. Why? Because the players use those levels for the reference and try to identify where the traders have got the stops and then try to hit the stops. Whether the traders follow the technicals or fundamentals and they know the cluster of stops where exactly they are, and mercilessly they make an upward stop and as well as a downward stop. So there is no bullishness and the bearishness in the market, because if you hold the position without any risk management, then they are bound to hit your stop. So once you try to take a position, then keep 30 pip stop or in case the hedging order is not available, otherwise you can keep an entry stop. So entry stop is a word given to that of the hedging order in the platforms. And so if it is filled, as I explained in the case of GBP, you will be holding a buy position at a higher level and a sell position at a lower level, and 30 pips will be blocked. And it is equal to that of the using the stop. But the disadvantage of stop is, once the stop is hit, your position is closed, and after about 10 minutes, if this market starts gaining, you would not have entered the position. And because obviously once you lose the money, then you hesitate taking the positions in the market, and by the time the market would have gone up. In case if they are dropping down further, probably you will feel happy that you have stopped out wisely. But if you use the hedging order will be filled, and you will be able to review whether the buy position or the sell position is making profit, and which way they intend to make a move, either on the downside or on the upside. If you feel that hedging order or the hedging position makes profit for about 30 minutes, that means they wanted to drop further down, you simply close your buy position, and the difference will be about 30 pips. So if you close your buy position with 40 pips loss, and 10 pips profit will be seen in your hedging position, and keep stop at entry and trail it down as they drop it, and gain more than 30 minutes, you will have 30 pips, you will have a break even. And if you earn further down, then you gain net profit. So this is how, if you are using the hedging, you have got either way trading opportunities. So once you keep the hedging order, then you try to see that you are able to keep stop at entry. Till such time, you will be keeping the hedging order. Once the position makes about 20-30 pips profit, keep stop at entry and remove the hedging order. So the hedging is used in such a situation instead of a stop. Then subsequently you keep a limit. So when the hedging order is there, don't keep the limit, because if they make the whipsaw move, then you will come across with an unfavorable position. So if you are able to keep stop at entry and then subsequently keep the limit, and if they hit you back and the stop at entry, then you will have a better entry level in the market, or you will be easily understand that that was filled during stop and subsequently you can think of taking another position. So, but you will not be risking any money. So you have to first of all reduce the risk to nil. That is first step. Then subsequently decide on the limit. Either it can be 30 pips, 45 pips, or 75 pips, and you can move the limit away from the market, but not the stop. And once the market moves in your favor, you trail the stop, and if they drop down suddenly, your stop will be filled, so that you will have a minimal profit. In case if they gain further, your trailing stop will move up and try to maximize the profit. So learn the technique of maximizing the profit. Invariably, the traders have got the psychology that whenever the position makes loss, they try to hold it for a long time, and out of fear, when the position makes profit, immediately they grab over 10-15 pips profit, and later on repent, I could have held the position. This is nothing but an impulsive condition, and if you use the trading strategy, then it is going to protect it, and you are not going to take any risk. If you are not keeping a stop at entry, then the position has got an unlimited risk. But if you keep stop at entry, you don't have any risk at all. Then in such a situation, you can try to maximize the profit instead of grabbing only 10-20 tips profit. So in my part 1 webinar, I showed you how exactly I use the trailing stop, and it's not necessarily they have to hit the trailing stop, and you can watch that they form the high, and that high has not been breached for 10-30 minutes. Then you understand, okay, they wanted to make a next downward swing. Before that, you close your position at the market also. So you can fine tune your entry, you can fine tune your exit, understanding the market, understanding how the players intend to make the moves in the market. So these are all the advantages of hedging I explained during that part 1 also. Here I'll just repeat it quickly. So hedging can be used instead of stop, as I explained in the previous example. The hedging can be used to continue trade when the market moves in our favor. Suppose in the case of GBP, my hedging was filled, I kept stop at entry, they made a little bit drop and then subsequently came up. So The hedging was closed at entry with the original position. I was able to take profit. And if you are smart enough, you can take additional buy position and book profit in that also. So there comes your fine tuning of the trading strategy. Because once one position becomes riskless, then you can take another position so that it does not lead to over leverage of your usable margin. Then hedging can be used to either way trading, as I explained. On the downside, if they make a move, you can book profit, and at the upside, when they make a move afterwards, you can book profit on the upside also. So either way, you will be able to book profit if you use the hedging. Then hedging can be used to reverse the trade, as I explained. You can cut the buy position and maximize the profit in the sell position whenever you come across the market moves against your expectation. Then, so that is bound to happen because no analyst will be able to give a 100% forecast or give any sort of assurance with regard to market moves, but we can only try to derive statistically and foresee this could be the possible moves, etc. But still, the players are making decisive moves in the market. So if the traders are all holding long positions predominantly, they try to hit the stops before making a rise. They don't just like that give profit to such higher level buy holders. Similarly, they don't give easy profit to that of the lower level sell people. So because normally the traders have got a tendency whenever the market starts correcting, immediately they tend to participate in that and quickly take a sell position. Later on, repent that at the lowest level they have sold it. So at the time of selling, it will appear as if it is going to drop another 100 pips, but that will be the last drop. And afterwards, they could have raised it. So that is why I always say that they make three levels of drop. In the case of Euro, you know that they made the 3 level, but they are all very nominal levels of 5 to 7 pips. But sometimes they make a drop of 30 pips. Then first drop they induce it in the market. The second drop, automatically the long liquidation happens. Then the third drop, the smart people think that they can sell and earn back that last money and try to sell at the lowest level. Then afterwards the market ceases to drop. And who are the buyers? The players are the buyers of them. They induce the drop and then subsequently they induce the long liquidation. They are the buyers. And the third drop, when the traders go in for short selling, thinking that market has become bearish, then all the 3 levels, the players are the buyers. Whenever they make an extended move of that nature, either on the upside or on the downside, they create the market feel and just act against that. They create the bullish feel. You know that Euro went up to 1.33 and they created a bullish feel, but they have been selling. But now they are creating the bearish feel in the market, giving so many interpretations with regard to the data. And knowingly or unknowingly, the analyst might also be contributing to their that intention. But subsequently, you find that the players reverse the market surprisingly. So you find always the players create the market sentiment and act against that of the traders. Keep that in the mind. So there is no question of trade with a trend and things like that. When you are doing a trade of a buy and sell of 30 pips on the or a sell and buy of 30 pips, you don't come across any big trend in that. The long-term trend might be an upward or a downward, but if you wait for such levels to be reached, probably the market may not show such levels. And you know that statistically the derived level is 1.582568 could be the possible support for Euro before making further rise in the downward channel. But they are not visible that level. If you simply wait for such levels, and even if they show such levels, you will have the hesitation in the mind and you will become very, very cautious and you may not take that buy position. And you will think that it is a dropping knife, so why to take the risk? So if you are having an uncertainty, then uncertainty will work in your mind continuously. And obviously, we have to use this trading strategy to limit the risk and maximize the profit. And so in the event of an emergency, suppose your position is being you are holding a position which is making unfavorable loss, and you can quickly, even though you are not using the 30 pips hedging order as I recommend, suppose you want to do hedging only in the event of an emergency when there is a quick move and things like that. You can quickly hedge the market whenever the market moves against your expectation, and you can leave the place and attend to your work and come back and review the hedging, whether the hedging is making profit or loss. And market does not run away. It is a 24 hours market, and you find again the market will go up and come down, go up and come down. So where is the question of bullishness and the bearishness? They alternatively try to hit the stops and make the money. So whenever they make such stop, and you try to trade along with them and make money. For me, trading along with that of the players is a trend. Then hedging can also be used to close the position at any time frame instead of stopping out the position during uncertainties. So suppose you are just hedged a position and left, and after 2 days only you are able to come back because you have to attend to a hospital and things like that. Then when you come back, you find that it is blocked up of 30-40 pips, and subsequently the market has gone up or gone down. Then it's quite far away. Simply you can close it with the original position, the hedging, still accepting only the 40 pips, and probably the platforms will have charged a nominal interest there, but still you have enough time to take decisions on such trades. And suppose a position is hedged and subsequently if you find that hedging is making profit, quickly take another sell position and try to book some more profit also. You understand the intraday trend is being set quickly, then subsequently you can take additional position and book profit also, leaving the hedging position. So there comes your smartness. Then hedging can be used to spread the risk. In case there are many traders, they go in for the averaging trading. Whenever there is a drop, they try to buy an average without understanding that it leads to that other over trading. But you know that market spread is so wide, about 1,600 pips, and every 150 pips on the downward move, if we try to keep the buy limit order and 30 pips hedging order and close the platform and come and see next day, some position will be making loss, some positions will be making profit, and understand, okay, the market is making further downward, keep some more buy and the hedging orders. Then during the month end, you just see the market has either come down to the bottom or gone to the upside. Then at that time, book profit in all the hedges which are making profit. Keep collective hedging orders below that and try to trail up as they move the market next month upward. Then you find that one by one you can close the buy side also. And there comes the skill set of the position trading. Just like that, holding a loss making position is not position trading. Position trading wherein you try to take a very minimal risk and maximize the profit. So hedging can also be used for breakout trade. In case if there is a sudden breakout, you feel that you can do a breakout trade, then you know that yesterday they made a breakout on the upside in GBP. Then one can take a buy position, then keep a hedging order below that of the initial high, and they went up and quickly dropped and came below that of the initial low. So if you are not able to keep stop at entry, at least you will see that your usable margin is protected. And if you try to keep a stop below that of the low, there are some people who calculate it as a risk reward ratio. Okay, I am expecting about 130 pips profit on the upside as per the chart and about 40-50 pips downside risk. So let me keep about 50 pips stop and about 100-150 pips limit, so that 1:3 ratio of risk and reward, but they may show the risk first. So we may think so many things, but ultimately what is going to happen in the market is very important for us. So don't take such unlimited risk or a wide risk of using a stop. In case if you are using a hedging order, fine, so that you will be able to hold the position and you can review and trade accordingly. But if you simply keep the stop, and you will be losing the money just like that. Then if the platform is high, the sell will act as a hedging. So that is how we have to identify. And I explained that they make more of a contrarian move nowadays. So you have to identify the right pair to hedge. It is not simply taking a buy position in euro and sell position in GBP will be able to give you that hedging. No, not at all. it may not work. Sometimes you may find that GBP goes up very fast, you might be staying and it might be making loss and your hedging will also be making loss. So don't go in for such pairs whenever you come across the contrarian moves happening in the market. Identify that either they are all making USD gaining move or USD weakening move. In such a situation, you can use them for the hedging purpose. So I given enough of explanations with regard to the market. So what is expected in this particular session? Euro and GBP are expected to make swing moves and rise for the weekend. So what's the trade? You can do it. Now you find it is 1441 GMT. So I took time to explain to you so that I can demonstrate to you they have stopped cutting the low in 30 minutes. And in the case of Euro, they come above that of the initial high. Initial low 1.2693. And in the case of GBP, they are not gained that much. And the recent low was 1.5470. Then they formed a new low 1.5444. They are smart enough. They are not cut that particular low for about 10 to 30 minutes. If they are taken a buy there, or you can wait for it to go above that of 1.5470, stay there for about 10 minutes, then you try to take a buy there and you will be able to see and keep the hedging order, because our reading may be right or may not be right. So we cannot just like that take a speculative risk, and we have to limit the risk, and then subsequently once the position makes profit, we can keep stop at entry. So you can understand, even though I had developed the algorithm with so much of work using various type of statistics, etc., still I don't trust it 100%, because the players make decisive moves in the market depending upon the pending positions, and they are deploying in the market. They are deployed in the market billions of dollars, and they do not want to lose such money and lose their prime ship, world richest number 1, world richest number 2 position. So obviously they will see that they are making very definite moves in the market, so that they are making 100% profit and no risk. So they are much more smarter than us. So obviously we have to understand that we cannot afford to take risk out there, risk in such a market, and it all depends upon the players creating the sentiment and act against that of the traders. So in that process, when all traders turn long, they know very well there's no point in rising the market, and then they start dropping. So when all follow the technical analysis or fundamental analysis, try to take the positions, and they just say that, no, this time it is not technical, it is fundamental. Then next time they will say that, no, it is not fundamental, it is technical. So you won't be knowing which one the market is going to follow next, whether fundamental or the technical. So this is how the analyst will keep confusing or creating the uncertainty. And obviously, to be on the safe side, as analyst, we can provide what could be the possible upside and what could be the possible downside, because market is known to make either way moves. So now we have seen that Euro is made a gain above that of 1.2693 and sustained there for more than 30 minutes. So I'll take a buy limit. Now I will not just like that buy market. I'll keep about 5 pips lower than that of the market. The current market level is 1.2610112. So I'll keep 1.2706, about 5 pips lower, so that when they are making a small swing, they will try to fill it. So that way, if you fine tune it, and don't think that quickly they will make a rise in the market and go to heaven or go to hell and things like that. That is not the way they do it, and they want the traders to commit the positions and then subsequently make the moves. So they take their own time to move the market. And if you think that after the speech there is going to be a spike, there may not be a spike. After the data release, there is going to be a spike. If you think, there may not be any spike. But after about 30 minutes, the traders might be committing position. Okay, the data is negative, so Euro has to go up. Then they will try to take a buy. Then they will try to make one downward stop and to hit their stops and make the rise. So always keep in mind that players are smarter than us. So we have to outsmart them. How? by limiting the risk, keep the hedging order so that if they hedged us, then review it. Okay, during the downward stop and only they hedged me. Let me book about 2-3 pips nominal loss in my hedging because the hedging is not making profit for 10 to 30 minutes. That means it was stopped it was filled during the stop and then subsequently I try to book profit with a buy position. So now you might be knowing the reason why hedging was removed, and in 2001 hedging was silently introduced in your trading platform, and subsequently in 2001 it was banned and they restricted all US trading platform not to use the hedging, and subsequently in 2003 they reintroduced hedging and again now they have withdrawn it. So now you can understand. So it is not that the hedging is disadvantageous to the other traders, it is disadvantageous to the other players because the traders hedge the position and hold it, and the players are not able to realize the profit. So entry stop of 30 pips. So if it is not filled in my observation of about 10 to 12 minutes, then probably I'll try to improve the order and try to take a buy. So it's getting late. So I'll just limit it and keep a buy limit order 1.5470, just 76 is showing with an entry stop of 30 pips. So this way we can review the market and without any fear we can try to take the position. There is no hurry in taking the positions, and obviously if you wait for a long time and look for the right opportunity, your trading will really go well. So let me see there are any questions asked here. I'm running short of time, but still I'll just see whether any questions are there. Okay, I'll just take about 2 minutes to finish up the questions. Hope you will not mind. The past performance does not guarantee the future. So you have to understand that you have to trade for yourself. Develop your own system and trade. People can give different ideas and based on their experience and based on their market reading, etc. But ultimately, you have to develop your own trading system depending upon the type of platform you are using, the usable margin you have, and the time you have available for trading. How long would you wait before you decide your original position is wrong? All 30 minutes or 10 to 30 minutes, and I have really become a master in this particular field, so I just wait for 10 minutes and take decisions. At times I take 30 minutes because I only look into the live market code page, so I was able to, because initially I was finding it extremely difficult when I was using the charts, etc. Later on, when I started seeing only the live market code page and no charts, then I was able to really read their intention. Questions? Don't ask for the level, then it will be difficult. But if you ask for certain concepts and ideas, I am willing to answer those things. And if you want to send a personal mail, you can use my email ID or you can contact me through Messenger. So, thank you one and all.